They remember that week as the day the little guy beat Wall Street. But in the same moment, in the back corridors, a different contract was being signed. A collapsing hedge fund received $2.75 billion in 24 hours. In return, a share of future management fees, future performance bonuses. Victory was declared in the square. Rights were moved through the pipes. This video does not heroize retail traders or cast hedge funds as villains. It traces where wealth moved, by the trading record, in the same week. January 2021. A perfectly ordinary company, GameStop, a video game retail chain tucked into the corners of malls across America. The way Netflix killed the DVD, digital downloads were killing the physical game store. Losses every quarter. Market cap under $1 billion entering the year. This dying company hit $24 billion in a single week. Wall Street was certain this company would go bankrupt, and it bet enormous capital on that certainty. More shares were borrowed and shorted than the total shares outstanding. S3 Partners and FINRA reported 226% short interest relative to float. The SEC's official report put the peak closer to 123%. The difference is a question of methodology. The decimal is not the point. More repayment obligations existed than shares in the market. This was an explosive device. When a stock rises, short sellers, who borrowed shares, must buy them back at any price. If supply cannot meet demand, the price must, in theory, rise without limit. The question follows. While the crowd was beating Wall Street in the square, where did the money actually go through the pipes? Who lost? Who really took it? In 2019, one man began quietly building a position. Keith Gill. Reddit. Deep fucking value. YouTube. Roaring Kitty. By day, an employee at Mass Mutual Insurance. Credentials. CFA. When he first looked at GameStop, there was no crowd. Only mockery. Only indifference. He saw potential in the company. The next console cycle. The possible entry of Chewy founder Ryan Cohen onto the board. Initial investment, $53,000. He quietly accumulated call options at roughly $8 per share, 2 years before the crowd arrived. January 4th, 2021. First trading day of the year. GameStop closed at $17.25. Beneath the surface, the structure was already primed to explode. Short overhang, rehypothecation chains. Nothing had ignited yet. From here, the event unfolds in 4 stages. Stage 1. The quiet powder keg. Stage 2, the crowd's discovery. Stage 3, the machine's response. Stage 4, infrastructure intervention. Stage 1, the quiet powder keg. Early January. The stock was still at $17, but beneath the surface, the explosive was already in place. Short interest was abnormally concentrated. Reddit's attention was growing. The options market was growing increasingly sensitive. Stage 2. The crowd's discovery. January 13th. Structural volatility broke open. Volume exploded overnight. Wall Street bets swelled to millions. Keith Gill posted a screenshot of his position. The $53,000 had become millions. People saw it. Closing price, $31.40, twice what it had been 10 days earlier. Stage 3. The machine's response. January 22nd. Deep out-of-the-money call purchases flooded in. Here is how that moved the price. Market makers who sold the calls were required, by regulation, to buy underlying shares to hedge. As call buying exploded, market makers mechanically bought stock. Stock purchases drove the price higher. Higher prices demanded more stock buying from option holders. The loop repeated. People called it a gamma squeeze. The options market clearly accelerated the fire. But the picture the SEC's official report painted was more complex. Short covering, options mechanics, and above all, a massive direct wave of retail buying, colliding simultaneously. The market did not explode from a single cause. Multiple valves burst at once. Closing price, $65, 4 times 10 days prior. Somewhere in a New York office, Gabe Plotkin must have checked the numbers again. Melvin Capital. Independent since 2014, averaging 30% annual returns. $12.5 billion under management at the start of January 2021. One of the most watched long-short hedge funds on Wall Street. Plotkin and his team were certain GameStop would go bankrupt. It was a dying industry. Short selling is borrowed shares. When the price rises, you must buy them back at a higher price. That is the rule. The higher the price climbs, the greater the theoretical loss, without ceiling. Stage 4. Infrastructure intervention, approaching. January 25th. The stock touched $159 intraday before closing at $77. The intraday swing was nearly $100. Prime broker margin calls poured in. Post more collateral. Reduce positions. More than $1 billion lost in a single day. January 26th. Close. $148. That night, Elon Musk posted one word to Twitter. Game stonk. Price exploded again in after-hours trading. January 27th. Short interest in dollar terms hit a historic peak. $8.89 billion. Close. $347. Plotkin would later testify before Congress. We were on the wrong side of a historic event. From here, stop watching the chart. Watch where the money went. 5 types of players were in this event. First, the collapsing short, Melvin Capital. Second, the capital that stopped the collapse and took future revenue rights, Citadel and Point72. Third, the settlement infrastructure that closed the buy button, NSCC and Robinhood. Fourth, those who entered before the crowd and quietly exited inside it, Senvest and Keith Gill. Fifth, those who earned fees without moving, BlackRock. What we're tracking now is not the stock price. It is where rights moved in the middle of the crisis. First movement, the losers' future revenue rights. January 25th, morning. In the square, news ran that GameStop was setting records again. In the pipes, something else was happening. Citadel LLC, Ken Griffin's hedge fund empire. Also the operator of Citadel Securities, the market maker processing roughly 40% of all U.S. retail equity trades. This firm injected $2 billion into Melvin Capital, Point72 Asset Management, Steve Cohen's firm, Plotkin's former mentor. $750 million injected, combined $2.75 billion in 24 hours. According to Melvin's LP letter, this was not an equity acquisition. It was a non-controlling revenue share agreement. A fixed percentage of Melvin's future management fees and performance bonuses, paid to the two firms. No voting rights transferred, no equity disclosure required. A claim on Melvin's future cash flows, structured to remain invisible. Why choose this structure? If Melvin had been forced into liquidation, $12.5 billion in long positions would have been dumped indiscriminately into the market. Citadel and Point72 held overlapping portfolios. Melvin's collapse would have been their collapse. The $2.75 billion was not a rescue. It was a strategic firewall against systemic contagion. Citadel and Point72 did not buy stock. They bought the losers' future revenue rights. While the square shouted, "The hedge funds are collapsing," the back rooms were quietly purchasing the future of those same losers. Second movement, the buy button. 5:11 a.m., January 28th. NSCC, the National Securities Clearing Corporation, which guarantees U.S. equity settlement, sent Robinhood an automated notification. Clearing fund collateral requirement, $3.7 billion. Robinhood's maximum available liquidity at the time, $1.44 billion. A pause. To understand where that $3.7 billion came from, we need to see the world behind the trading app. Press the buy button on a stock app. The trade feels finished. But in the settlement system behind it, nothing is finished. It takes 2 days for money and shares to actually change hands. For those 2 days, someone must answer, if this trade fails, who is responsible? That guarantor is the NSCC. When GameStop volume surged roughly 21,000% from early January, NSCC's risk algorithm calculated the potential loss Robinhood would bear if its open positions collapsed. This is VAR, value at risk, a calculation of how much could we lose in the worst case. That number alone, $1.3 billion. Then came the ECP, the excess capital premium, a punitive surcharge, on grounds that Robinhood's regulatory capital was dangerously insufficient relative to portfolio risk. An additional $2.2 billion was demanded. That single figure exceeded half of the total $3.7 billion. In plain terms, your capital is far too small for the risk you're carrying. Post more collateral. Robinhood's executives would later call this clearing algorithm a black box. Between 6 and 8 a.m., Robinhood's leadership entered emergency negotiations with NSCC. 9:11 a.m., 19 minutes before open, NSCC waived the $2.2 billion surcharge. 6 member firms facing similar pressure that day had their combined $9.7 billion waived in aggregate. According to the House Financial Services Committee report, without this waiver, Robinhood could not have met the 10 a.m. deadline. The settlement system repealed a rule it had created. The same day, when the system itself faced a paradox, its risk defense mechanism becoming the risk, it opened the valve. But there was a condition. New purchases of GameStop and similar meme stocks would be restricted. 9:30 a.m. As markets opened, the buy button turned gray. People believed someone had switched off the button, but more precisely, no single phone call closed it. What closed the buy button was the system built to guarantee settlement 2 days out, the collateral that system demanded, and the capital structure of a broker unable to meet those demands. The House Select Committee investigation found no evidence that hedge funds or market makers pressured Robinhood to restrict trading. The structure is more frightening than the conspiracy. Conspiracies end when exposed. Structures continue operating whether anyone notices or not. What NSCC held was not money. It was the valve, the one that could change the direction of the market. Third movement, using the crowd as exit liquidity. 2 days before Robinhood closed the buy button, somewhere outside the square, a different set of numbers was printing. Senvest Management, a New York-based hedge fund most people have never heard of, co-managed by Richard Mashal and Brian Gonick. In early 2020, at a consumer conference, they listened to GameStop's then CEO present and spotted a possible turnaround. Serious accumulation began in September 2020, below $10 per share, a position exceeding 5% of all shares outstanding, built quietly, without anyone watching. Their sell trigger came the night of January 26th, when Elon Musk's tweet sent irrational liquidity flooding into after-hours trading. Mashal used that liquidity as an exit. The moment the crowd burned hottest became the doorway out. According to the WSJ, $700 million in 5 months. They entered before the crowd cheered. They exited when the cheering reached its peak. Senvest used the crowd's heat as exit liquidity for profit. Fourth movement, profit without moving. BlackRock, the world's largest asset manager, index funds and ETFs, passive management by design. As of late 2020, they held approximately 9.2 million shares of GameStop. Not by intention. The stock was index included. They simply held it. By late January, that position had expanded from $170 million to over $1.4 billion in paper value, without doing anything. Beyond that, BlackRock was the largest lender of GameStop stock. Short sellers who needed to borrow had to come to BlackRock. Stock lending fees annualized above 80%. A long-hold passive fund, collecting near-riskless lending income inside the market's irrationality. BlackRock did not move, but the system moved for them. Fifth movement, the profit of the one who entered first, and Keith Gill. The position started at $53,000. By intraday on January 27th, it reached $48 million on paper, roughly 900 times. In his February 2021 congressional testimony, he said, "I like the stock." On allegations of illegal manipulation, he had simply analyzed publicly available information and shared it honestly. He won. That is a fact. Individuals can win. That is also a fact. But the crucial distinction, the fact that individuals can win, and the claim that market infrastructure is designed to favor individuals, are entirely different statements. This is what happened inside the pipes. Citadel and Point72 did not buy stock, they bought the loser's future revenue rights. NSCC did not profit from money, it held the valve, the one that could redirect the market. Senvest used the Square's heat as exit liquidity. BlackRock earned lending fees and paper gains without moving. Keith Gill entered before the crowd and carried the risk before there was a crowd. Same event, but not everyone was playing the same game. February 19th, 2021. GameStop closed at $40.59. 3 weeks earlier, it had touched $483 intraday. The Square had cleared. The pipes were getting stronger. Melvin Capital lost 53% of its assets under management in a single month. Approximately $6.8 billion evaporated. Despite the $2.75 billion infusion, the fund never recovered. May 2022. Gabe Plotkin officially announced Melvin Capital's final liquidation. The January 2021 losses had eventually consumed the firm. Around the same time, Andrew Left of Citron Research posted a public statement. 20 years ago, we founded this firm to protect retail investors from Wall Street's entrenched powers. And now I realize we ourselves have become precisely that entrenched establishment. Effective today, Citron Research permanently discontinues the publication of short-selling reports. 10 days earlier, Left had publicly mocked the idea of GameStop's stock staying above $20. 2 weeks later, a public surrender. The fire did not stop at GameStop. AMC Entertainment, $2 to $20 intraday. KOSS Corporation, $3 to over $100. BlackBerry, Bed Bath & Beyond. One common thread: high short interest, weak fundamentals. According to the SEC report, the single most powerful force driving GameStop's price in January was not short covering. It was not the options mechanism. It was the massive direct buying pressure from concentrated retail investors. Daily active trading accounts growing from under 10,000 in early January to roughly 900,000 by January 27th. Global retail trading accounts exploded. Millions opened their first brokerage accounts watching this unfold. But one thing must be noted here. Even the most brilliant winner could not time the peak. Senvest's Richard Mashal sold GameStop on January 27th at an average of $112 per share. The next day, the stock touched $483 intraday. According to Bloomberg, Mashal later admitted, "If we had held longer, it would have been far larger." Even the best-positioned winner, ultimately shaped by luck and conventional risk management. It was not genius that won. This is not a story that says individuals can never win. Keith Gill won. Some individuals won. But many who entered when the crowd was loudest, in late January, held positions through February's $40. Same event, different games. We watch the price. We watch the chart. We watch red candles and green. But in a crisis, what moves markets is often not the cheers above the chart. Settlement dates, collateral, liquidation, lending fees, and invisible valves. The Square can declare victory, but when the pipe closes, victory cannot be settled. In this event, wealth followed 3 laws. First, those who entered before the crisis took it. Senvest entered 5 months before the crowd heated up. Keith Gill entered roughly 2 years before the crowd arrived. Many of those who entered at the height of the crowd's cheers held their positions through the silence that followed. Second, those who understood the structure of the pipes took it. Citadel and Point 72 moved because they knew Melvin's forced liquidation would cascade through their own portfolios. BlackRock earned lending fees without moving, through the stock lending system. Those who understood the pipes profited from the pipes. Third, the buy button was not closed by Wall Street. It was closed by the algorithm of the settlement infrastructure, and by the capital inadequacy of a broker that triggered that algorithm. The fact that Keith Gill won does not mean that infrastructure was on your side. The infrastructure operated exactly as it was designed to. So the final question is this: who controls the settlement, clearing, and brokerage of my position? When the price is on my side, can that infrastructure cut me off? Am I watching the square right now, or the pipes?